Hi everyone, welcome again to another video session with Ted and I. We're going to be analyzing another company, another request that came in. Company is a good one. It's an interesting one to look at actually. This is a company called Remote Monitored Systems, and they're effectively a holding company. So they own, or at least majority stakes and 100% ownership in two companies. So the first one, which they state is the one that they are focusing the majority of their time on, is a company called Gyrometric Systems. And they own about 58% of this company, so a majority stake in the business. And what they really do is they kind of manufacture digital monitoring systems, safeguard systems for rotating shafts. So they collect and analyze digital data that basically helps companies that have these rotating shafts to be able to spot, recognize, and deal with any faults before they become a big issue. So think about, in the aviation industry, shipping industry, wind turbines, etc. So these companies are able to observe and notify themselves very quickly if there's a problem with those rotating shafts. So very important system to have for these businesses. The other company that Remote Monitored Systems own is they own 100% in this company, and this is a company called Cloudveil Limited. So they're involved in security risk management, management information systems. So we're going to be looking at this business to understand a bit more about them and what do the finances say about it. What's interesting are a couple of things. Number one, they state very clearly that their interest and their objective is to acquire or acquire interests in other businesses, and they're looking to do that because they see that as their path for near-term growth. So we're going to look at the finances to see what their growth has been like so far, and have some context behind that. The other thing to note is the share price. Now, they IPO'd in 2014, and their share price has taken a real battering. So in 2014, their share price was worth £260. It's now worth just over £1. So we're going to look at those finances to see if those finances can kind of give us a hint as to why this might have been happening. But of course, don't just look at the finances. Although we're doing that analysis on finances, you must look at everything else, including the people involved in the business, the industries they're involved, the compound annual growth rates, etc. That is going to be very important to your investment thesis. So we're just helping you with the fundamental financial analysis. We encourage and recommend that you look at all these other important areas. So thank you, Gary Smith, for making this recommendation. Although he writes remote monitoring systems, Ted and I could only find remote monitored systems. So hopefully we have the right company. Do let us know, Gary, if we have. Before we go into the analysis, don't forget, like, share, subscribe, so you can get notifications on all the other businesses that we're looking into as well. So Ted, let's look at this business. We found some interesting and some worthwhile information here.
Absolutely. So welcome, Moeed. Good to see you, and I hope you are well. So let's jump straight in. So we're going to look at the financial statements. We are recording this in June 2021, and we should really be looking at year ended December 2020. Unfortunately, those are not available. We're actually going to be looking at the 2019 accounts, which were filed on the 17th of July 2020. So I just wanted to bring up this slide here just to show you that the company, that there's nothing they're not behind schedule or anything. They have a tendency to spend 6 months doing the audit, getting it all sorted out, getting the accounts signed off, and they generally file almost very, very regularly in July. So we'd expect the latest set of accounts to come out in the next couple of weeks, but we don't have those, so we are going to be looking a little bit historical. And as you said, there's going to be lots of things which will happen to this company since the 31st of December 2019, which we are not aware of. So if you have insight, do make your comments in the comments. So let's jump straight in and have a look at their accounts. So they are available on Companies House, but you can also get a nice glossy version from their website underneath investors. And if you jump onto their website, you will see their financial statements. Here they are. We're going to jump straight into the actual numbers, which start on page 22 with the income statement. So here is the income statement. Now, some really interesting numbers going on. The first thing that jumps out is that they didn't make any sales last year. Okay, so sales and cost of sales in 2018 was 0, and the sales in this year were about 52,000. You'll notice that this is in pounds. This is not in millions or billions or trillions. 52,000 pounds. Cost of sales was 27,000 pounds. They make a gross profit of 26,000 pounds. Okay, so this is not very big. Now, the fact that they've been around since 2014 suggests that they're probably not in the same business that they were in 2014. There's been some significant changes in this company. They've moved out of one area into another area, and it's almost like they're just starting again. The administrative costs, meanwhile, over £500,000. So there's 615,000, a little bit down from 655,000 in the previous year. And then in this year, we notice big impairments. Now, this is a kind of a one-off charge. This is basically just writing down the value of your investments or your intangible assets. And so, in fact, you can impair tangible assets as well, but this happens to relate to intangible assets. So this will be them writing down the value of their investment in one of these companies, which kind of makes sense, because if you're not generating any sales, then it's probably not worth very much. So they put it, they're interesting enough, and I have to admit, I wouldn't necessarily have done this. They've put these numbers above, what we call above the line, and the line I'm talking about is this one here, which is their operating loss. So I've kind of recalculated it and said, look, what if we just compare the operating, the gross profit with the cost of operation? What do we get to? We get to an operating loss of 590,000, which is an operating loss margin of 1,120%. If that makes any sense at all. It really doesn't. Basically, we can take their sales as still being effectively 0, or maybe it is a sign of things to come. A little bit further down, we then notice some very big losses here. So we've got the loss from discontinued operations. So this is really, really significant. So there's a little bit of finance costs. This will probably be on leasing, maybe a little bit of debt, but really this is the big number here, the loss on the discontinued operations. So in 2018, they'd have exited some operations that have closed down parts of the business and recognized a loss of 325,000. In 2019, they closed down some more parts of the business and recognized a loss on closing those of over £1 million. Okay, so for a company that states in its strategy that it is there to go out and acquire businesses, if that's what they've been doing in the past, I'm not convinced that it's really worked out for them if they've had to close the businesses down. And as you've said, they've seen a big change in the share price. So remember, when you're buying a company, you are investing in the management. Is it the same management, or is it a different management? What is their story? Why are you investing in them? So anyway, the summary is, bottom line, these guys have booked a loss. They booked a total loss in the last year of £1 million, and they booked a loss in this year of £1.6 million, which is a net profit or net loss margin of over 3,000%, but that's a pretty irrelevant figure. So let's look at the strength of their balance sheet sitting behind them. So here is their balance sheet. The first thing we notice from their balance sheet is that there has been a very big fall in the non-current assets. So the non-current assets, these are the things that we need to run the business. And we can see the intangible assets, which is the value of the investments. They've been written down substantially. That'll be their impairment. And also we can see that the property, plant and equipment has also been significantly devalued. And notes 14 and 15 will give us a little bit more information on that. Now, with £1 million in that short period, I'm either thinking either they've devalued it because they've written it down through the impairment, or they've actually sold it, or a combination of the two. Let's go and have a look at note 14 and 15 and just see exactly what is going on. So here we see the other intangibles, and we can see the there's amortization going on, but you'll notice here that there's a lot of kind of reclassification of assets held for sale. So this is reflecting that they've got these intangibles. So things like the intellectual property rights, development costs, customer lists. Quite interesting. They've actually put customer, so they've obviously bought those customer lists, and then they decided that they're just not worth anything. So they're actually just basically putting them up for sale and effectively getting rid of them. And we'll see in the cash flow statement how much they managed to get rid of. That's really reflecting this reduction in the reduction in the non-current assets. So shrinking business is our summary from those numbers. So let's jump back to our balance sheet again. So we see that the non-current assets have significantly fallen. The current assets are staying broadly the same, although you'll notice that suddenly we've still got some assets for sale. So they're still trying to get out to parts of the business, and they've actually got those, on eBay, so to speak, and they're trying to get rid of them. Trade receivables has come down as the business is beginning to shrink. They're really kind of pivoting. They're moving out of one area and into another area. Scrolling down a little bit, and we look at the current liabilities. What we might want to do is to look and to compare the current assets here, 315,000, with the current liabilities, which is this number down here. So the total current liabilities, 667,000. Okay, and again, a similar story in the previous year. These guys have liquidity problems. So in effect, that 315 is cash or going to become cash soon, and the 667 is something that has to be paid soon. Okay, this is a big alarm bell. That's about a 0.5% liquidity ratio. You can survive that if you have very strong cash flow. I'm guessing that with no sales, these guys are struggling on their cash flow. When we look at the numbers in here, we've looked at previous companies where we find things like deferred income in their current liabilities, and that's just payment in advance from their customers. No such things for these guys. They've got trade and other payables, who will be their suppliers. And if I was a supplier to this company, I'd be getting some very squeaky bum time and might want to get myself a new pair of underpants. And also Social Security and other taxes, which is HMRC, who are not known for being that lenient. If you owe them money to them, they'll want it back. Now, again, quite interesting that they're very similar. So maybe it's a timing issue, but it looks a very high amount to owe to a company where the total costs of running this business are only 600,000. So, and Social Security is 200,000 outstanding at the end of the year. I'm starting to guess that there's a little bit of negotiation going on with HMRC and that they are struggling to repay that amount. That's my speculation, though. I don't have the numbers and I can't prove that. So not looking too healthy. There's no real non-current liabilities to speak of. What is interesting is that the deferred tax liability has been paid off, so that's good. They've got a little bit of other provisions. There's no debt here. It doesn't surprise me there's no debt. If I was a bank, I certainly would not be lending to these guys. So the equity, and we'll just scroll back up again just to show the equity sitting in the middle. So as you might expect, this company is funded through investment, equity investment. A lot of that will have been raised when they floated back in 2014. And ever since they raised the money, they have been sitting on just generating loss after loss after loss, never really delivering the jam tomorrow. and we noticed they ended up with a negative balance sheet, which means that if you put this company into liquidation, the assets are less than the liabilities. So the shareholders will walk away with nothing. Technically insolvent. Now, it's not actually insolvent, it's just technically insolvent. So as long as you can trade, as long as you can meet your financial obligations as they fall due, it's not a problem. Let's go and have a look at the cash flow statement, which is an important part of this, and look at, whether they are generating cash. And we see down the bottom here is the cash, and we notice that not only are they making a loss, they're also burning cash. They're burning £500,000 in cash each year. We then scroll a little bit further down the cash flow, and we see that they, last year there was lots of investment going on, property, plant and equipment. There's a little bit of investment going on this year, but not a lot. They're selling some, they're buying some. They're not investing because they haven't got any cash. They really can't afford it. Here's the acquisition of their subsidiary. They talk about, a good game. We're going to carry on buying other acquisitions. They haven't got any cash to make those acquisitions. So I'm not sure where they're going to get funding from. Looking at the financing, these two numbers here is the sort of refinancing of a loan. So they did have a loan in the previous year. They refinanced it. And there's a little bit of a loan going on here, loan notes here. So again, a little bit of refinancing going on, but it's not a substantial amount of debt sitting on the balance sheet. So it looks to me like, they're kind of, the debt that they do have, they're refinancing multiple times during the year. So it's very, very, very short-term loan, little bit of lease repayments going on. And you can see that very clearly they're funding their business by issuing shares. £745,000 in the previous year, £600,000 in this year. So effectively, they're burning cash and they are funding themselves by issuing shares. And as long as the shareholders are happy to put their hands into their pocket and carry on stumping up money, then these guys will survive. And if they stop, then these guys will fall over. And this is acknowledged. So if we go and look at page 8 in the director's statement, this is the statement of directors, and they talk about this thing called this going concern, which is, can we carry on trading? They said we've assumed that we can, that we're good for it. And they talk about, how much net cash they've got, 266,000. And they expect to raise additional funding by the end of the calendar year. That is their statement. If we then go to the Auditors Report, and that's on page 19. So here we are looking at the Auditors Report, and the Auditors Report is talking about this thing called material uncertainty. The word material basically means very significant. I was saying that, there's a significant chance that they are no longer going to be a going concern. They highlight the fact that they've made a loss, that they've got these liabilities, that they can't afford to pay the liabilities. The net liabilities of 344,000. That's the current assets net of the current liabilities. They're making a loss, they're burning cash, they've got debts they can't pay, they've got a negative balance sheet. I don't think anyone's going to lend to them. I certainly wouldn't lend to them. They don't really have any assets to sort of lend on, and therefore they're basing their survival on their ability to continue to tap the stock markets and to raise additional cash. So the fact that we're having this conversation in June 2020 suggests that they're still alive. They've managed to raise money during 2020. It'd be very interesting to see what their accounts look like in 2020, whether they really are showing that they've turned the corner and suddenly the future is looking very rosy and you're going to have to start wearing shades, or whether they are still limping along, burning cash, making a loss, and struggling to make the payments. just a comment on this. This is quite an interesting company. We've seen quite a few companies like this. There's a lot of cash out there. There's a lot of cash from the pandemic, a lot of quantitative easing been going out there. It's flooding into the markets. The money has to go somewhere, and a lot of it is going good companies after bad. And maybe we are looking here at what we call a zombie company, a company that's making losses, it's burning cash, it's limping along, and maybe it's just being kept alive by, you know, this cheap cash that has to find a home somewhere. Now, you may disagree with me. You may say, no, Ted, this company, it has had a bad past, but now it's cleared out the past. And don't forget, when you invest in a stock, you're investing in the future, and the future is very rosy for this. And if you think that, then please do add your comment in the comments of YouTube. So our summary is, let's have a look at the share price. Here we go. So the market cap is £19.75 million. As we talked about, the balance sheet is negative. So that's all goodwill. Effectively, if you buy this company, you're buying something where the assets are worth less than the liabilities. It has no earnings, so there is no PE ratio to speak of. In terms of sales, you're paying 375 times the 2019 sales. That's kind of, I wouldn't pay that, let's put it like that. But then, of course, 2019, we are 18 months on. So I do appreciate we're looking at out-of-date figures. Quite interesting looking at the share price. So something must have been going on round about the end of 2019 to get everyone very, or 2020 to get everyone very excited. The share price bites. And so if you'd invested here and you got out here, if you were very, very clever, in fact, you wouldn't be clever by doing that. You'd be very, very lucky. But if you had done that, you'd have made a lot of money. Absolutely. But then, of course, if you'd invested here and now you were sitting down here, then you are sitting on a very big loss. So absolutely, Moeed. This only starts in 2018, and the company IPO'd in about 2014. I think it IPO'd somewhere up here, and it went all the way down and then just basically bounced along here. Good news in the market. Not so good news. Yes, there is good news. No, there isn't. And you can start to see, the day traders love this kind of stuff because they can make and lose a lot of money based on the volatility. But is this a long-term investment? You know what, Moeed? It's not for me. Let me put it like that. If I can be absolutely clear.
Yeah, I agree. Not for me either. But if someone watching this knows a little bit more about this type of business or the industry that they're involved with and the business that they've acquired, leave a note in the comment section. Would love to hear your thoughts. Two videos that I really recommend you watch as well, because they are some way connected to this one. So the first one is Iconic Labs, which we analyzed. Now they moved from one industry and shifted completely to another one, which looks like what these guys may have done in the past and recently done so again. So have a look at Iconic Labs finances that we analyzed, because you will see some sort of trend and similarities in how you should be analyzing such businesses. The second company to look at, not similar in respect to what they do, actually nothing at all like it, but it's an example of a company that's at a new technological area. And if they make it big, they're going to make it really big. So it's worth looking at their finances. And that company is called Seeing Machines, which is an Australian business that we recently analyzed. So have a look at those two companies. We're going to put them up there so that you'll be able to look at them. Hope you've enjoyed this video. Like, share, subscribe as always. Ted, we'll see you on the next video. Thank you, everyone.
Good to speak to you, Moeed. Catch you later.